one.
Hello and welcome to Money Matters. I'm Sarah Peterson here with Dean Greenberg of Greenberg Financial Group. How are you today, Dean?
I'm doing good. Every time I'm with you, I'm doing good.
You always got that big smile on your face. You're ready to talk money.
Money is a very interesting word. People think it's the end all sometimes, and it's not. It's just a means to an end.
Well, and you know what? This is what we talked about on, previous shows, that you love to get to know your clients and know what that end is. Like, what's their story? We make money for a reason so that we can live a certain life. What is that life?
I do ask people how they view money and what their money's for. I mean, obviously it's paying bills, it's just, all it is telling you what kind of lifestyle you want to live. And are you going to if you're going to live a lifestyle that's more than you have, it's going to create problems. If you live the lifestyle from what you're able to earn, then you're always going to be rich.
Well, it sounds trite, but if you have your health, you have kind of everything. And health and wealth are so inexorably intertwined. I would say the two most personal things you can deal with when you're working with somebody. So you get to know your clients on such a deeper level. Just like we go to the doctor and get a second opinion, people come to you and they want to know, hey, Dean, am I okay financially?
Right. And it's amazing because 29% of people are the only ones that are getting financial plans now, and there's almost 70% of people say they need one. So there's a big gap in there.
Why are they dragging their feet? Why procrastinate?
Well, I think one of the things is that most advisors are 55 plus, maybe even in their 60s or more. And they never were really into the financial planning thing. But if you now look, everyone's doing financial planning. Everybody. I don't understand how you can do a financial plan unless you understand financial planning on just plugging in numbers on the computer and saying, oh, I got an answer. Because there's so much more in depth to find out about people, to talk to them, to find out really what their risk tolerance is. But so many people don't want to talk to people because of fear. But I'm telling you, if you want a real plan, you got to go to somebody. Whether it's us or somebody else, just plugging in numbers and getting an estimate of what your financial plan looks like. It's really like a watered down budget.
Is there a perfect time to start?
A perfect time to start is the day that you say, I need a plan. Now, ideally, starting in your 20s is a great time. It's easier. You put money away. You're trying to budget. It's really more of a budget in your 20s. You may be buying some risk protection, because obviously insurance when you're in your 20s is much cheaper than when you're in your 50s. And you're also, pre or starting a family. Now you're starting a family. Everyone, oh, what do I do? Well, you start planning then, because now you got a spouse that you got to worry about. You have some debts if you have a house. You might have children that you got to put money away for education. So what are you doing there? Then as you're growing, what are you doing for also putting money away for retirement, putting money away for vacations, putting money away to do it? So all those early years is putting money away for retirement, but also putting money away for the things you got to do for what I call life. The difference is, what it really is just a budget, and allocating the monies in the right way, but it's more protection when you're younger. Someone in their 30s making $100,000, $200,000, and the wife is at home taking care of the kids. God forbid something happens to them. What does she have? It's going to change the lifestyle. So that's when you definitely have to get either some cheap term, something that they can afford to be able to replace that income of maybe for 5 years or something for them.
Well, that being said, we all experience change throughout our life, and maybe the last few years has created a lot more change for most people than in a very short time. But this is not like a set it and forget it type of situation. We need to revisit these plans on an annual basis or more often sometimes.
Yeah, depending on how old. I mean, like if you're 10 years from retirement, you better get off your butt and go do something. Okay, it's that simple, because you got to start planning on the money you're accumulating, whatever pension you might be getting, which is very few people are getting it now, unless you work for the state or something or the government, and how much you accumulate in your 401k. And you better start looking at what that income gap is. You're making $150,000, and now you're only going to be able to create 75 grand. Okay, how much of that is going to debt? So how much you really need at that time? You better start putting some money away to increase your income in 10 years. You know, and that's what people don't realize. That income gap is, especially for like federal employees, we see it a lot. You know, because you don't get your full amount, you get less, and it's a nice pension. But if you have to fill up the gap, if you're only going to get 60 and you need 90, how are you going to fill up that $30,000 a year?
And that drives maybe fear also for people not necessarily taking that next step, even though they might be emotionally ready to retire, right? They're a little scared. What will I do when that income stops?
Right. Income is addictive. There's no doubt. It's amazing how, I don't understand how many people don't even work. You know, they just get the free money or whatever, but you know you're not accumulating anything. What are you going to do when you're older? I just don't get it. Live for today and never worry about tomorrow? Tomorrow's going to come sooner than you think, right?
Absolutely, and that's why I think I'm always surprised when you give me the statistics of all the people that want to get a financial plan and know that they need one and don't take that next step, because to me, there's no time like the present. If we've learned anything in the last few years is we don't know what the future is going to bring, right? So now's the opportunity to take that time, find out if you're on the right path, and if you're not, get there so that you can have the peace of mind to live the type of life and then retirement that you want to live.
You know, it's interesting to see that people with more and more money are coming in for a financial plan. You know, I've had some people in their late 70s that come in and I said, I don't know if you want this or not. This is what we offer. And they want it. They want the picture. They want to see where they're at. And that planning more is, okay, I got enough money. I'm not going to live my money, but now what am I going to do with my money? That's where their planning comes in, their legacy planning. So every stage has a different way that you can plan for them. And, you know, we happen to be well-versed in all of it. But what's really cool about our office and our team, Dave and I have been in the business over 40 years, okay? And we have a lot of experience on how to manage money, how to mitigate risk, how to put things together. But I'm very worldly in what's a good interest rate, okay? If you're getting a mortgage, I've helped out 5, 6, 7 people lately to get a better interest rate and less points for the mortgage company, because obviously they're hurting too, but I don't want my clients to get ripped off. I'm not getting extra money for that. It's part of being a financial advisor. Understand the mortgage market. Understand how you get car loans. All right, somebody, someone wants to give someone 9% on a car. I said, let's figure this out. We can get lower than that. All right, and they don't get it. I mean, unless their credit's bad or something. But all the stuff that has to do with financial stuff, we will advise them and help them through that process that most of them don't understand. The young people, I got young people in my office. They're going through it. I've got old people in our office. So we understand what we have to do when you're 50, 60, 70 years old. We understand. And every crash that we've had since 1987, I've lived through, survived, and did better afterwards.
And other advisors charge thousands of dollars for this. You've decided to do this for your clients because you want them to be educated and to know if they're in fact on the right path. And then if they choose to work with you, that's just the added bonus. It's really such a gift. So I'm going to give you that phone number again. It's 520-544-4909 and the QR code at the bottom of your screen. Scan that. That's going to take you right to Greenberg Financial Group. If nobody answers, please leave a message. This is not a call center. You're going to get right to us. We're going to take a quick commercial break. We'll come back and talk more about the importance of financial planning and why you need one.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg, president of Greenberg Financial Group, and we're talking about the importance of a financial plan and how many people want one and don't take that next step to get one because of fear, and fear drives way too many of our decisions these days. We want to take that fear off the table and give peace of mind so we can move on.
I'm going to go step by step on how simple the process is to work with us. You either go on the website, contact us. You either pick up the phone, call us. You will talk to Todd, Dylan, myself, Dave, Claudia. Somebody in our office is going to pick up the phone. You'll say, hey, I'm interested in the financial plan that's for free. No problem. Let me give you somebody that will set that up. You see the Todd, Dylan, Sebastian, they'll set up the financial plan. What they will tell you during that phone call is what they're going to email you to be able to get the information and gather the information to do the financial plan. They will also send you a risk analysis, which will also give you your own personal risk tolerance score. Then when we get the portfolios and stuff, they will do the risk tolerance on there, get all the information, the Social Security, the pension, everything that you got, they put it in. Once that's in, they call you back for a financial plan. Sometimes you do is you actually come in with all the stuff. Depends on how you want to do it. And we get it, we gather it, we tell you what the process is going to be. We get all the stuff, we put it in, you come back for analyzing the financial plan, tweaking it, doing whatever things that make sure we're on the same page. The beauty of the financial plan, and Dylan and Todd are going to come on one of these shows and talk about it too, is they're able to tweak it what ifs. What if you made this much more money? What does it do here? What if this happens? What if I have a health problem? What if my Social Security, I waited 3 years? What if I, with Medicare? What if whatever it is, they're putting all these what ifs, and they do this Monte Carlo simulator, which all it does is, like Monte Carlo, but it's tell you what are the chances out of 100,000 times that your plan will be 90% successful, which is kind of cool. So that's how they tweak everything. And so then they go over that. That's fine. Then they come back again. We all get together as a team and discuss what is the best proposal for them, if that was our money, what we were doing, and if we were in their shoes. We come back, we show them the proposal, we go through it, they like it, they don't like it, they like some of it, they want some of it, they want this. They say, okay, I want to do business with you. Then we show them how we're going to manage the money for them. And then we go ahead and bring the money over. Then we meet with them again, show them what we're doing, and sign paperwork and go from there.
Let's talk about risk. That word that you used I find to be so interesting because I think majority of people don't know how much risk they are taking. They don't know how much risk they're willing to take necessarily. It's kind of a broad topic, and there's so many subgroups that I think of when I think of risk. I'm thinking investing risk, but then there's tax efficiency risk, and there's the risk of longevity, living too long, outliving your money.
What about when your spouse passes? Nobody talks about that risk because it really is not a fun thing to talk about. But when your spouse passes, your income goes down, usually, all right? Because you're getting, if your Social Security goes down, if you're both getting it, your pensions go down if you're both getting it. If only one person worked and the husband goes down, then everything is less. So you got that longevity risk, all right? Do you have enough money to pay for all the debts risk? Okay, liquidity risk. But then when you get into your portfolio, you have interest rate risk, you got market risk, you have all the different types of risks. Mitigating all those risks are very important. It's easy if someone has a mortgage on the house and they don't want to go ahead and burden the kids with it, but they want their investment portfolio, you buy some cheap insurance. Pay off the house, the mortgage when it's there, especially if you're still married.
Right.
And because having no debt later on in life is probably a good thing.
Well, your risk tolerance changes throughout life. I mean, when you're in your 20s and 30s, you have time to make up. If you lose your money, well, I'll make it up again. As you get older and closer to retirement, you should be less tolerant to risk.
Right. Well, or have different accounts or different things. I mean, it's funny. What I do personally, I'm a risk taker. But business risk taker, entrepreneurs. I've had restaurants, okay? Most people know Shlomo and Vito's and Samuel's Place and stuff. And it was fun. And we made money till 2008. But I never put myself in such a position of risk that if something tumbled down, it took everything else down. Some real estate did great, some real estate didn't do well. But you take risks as doing things, okay? But the core, and it's always the core, and that's the one you protect, has been my investment business. You know, starting it at 88, it's been the core of what I've always done and grown. But as you made money, you go into stuff. It's just, you have one life. People say, why do you do all this? I said, because that's who I am. If you're going to be successful, you like doing other things. You like trying other things. You like employing people, all right? But then you find out later, the people you employ in the restaurant business, you can't treat them the same way in the investment business. They're not the same person. Okay, showing up for work is almost impossible for half the guys, and half your kitchen is one step out of jail.
Right.
You know, and so you deal with a scenario that's totally different. But what does it do? It makes me more worldly on all the different things that happen. I could run it. I can definitely know how to make a restaurant work now. But most people, it's about working there and being there and having the right people and the food course and all this stuff. It's just amazing how much you learn by failures. And I've always
and
believed
trying
that.
and failing is sort of something we think about, like, earlier in life, because as you get older, you don't want to fail because you don't have the time, the energy that, to build yourself back up again.
And that's why we mitigate risk in portfolios. And I don't know anyone else that really does that on a retail, individual type level. Sure, they do it on pensions and profit sharing plans and institutional accounts and hedge funds and stuff. They all mitigate risk. But for the actual retail investor, I haven't come across people that do it. They put them in these models and stay there all the time. I know how to do it. I know how to sell calls, buy puts. I know how to buy the inverse funds, the percentages. I know how to put models together to protect from a big fall down. And we do that on an individual basis and also help with taxes by doing it.
I think we're in this society, you could click on almost any site on social media or whatnot, and they would say, take our quiz to find out, what type of hair care you should be using, or take our quiz to find out, like, what size shirt you wear, etc. This is not that type of situation. I don't want to take that quiz online with somebody who doesn't know me, know my needs, that I have 4 kids, that I might have, I may have X dollars, but where do I want to put those? I've got 4 children. I have, one of them is inevitably going to probably stay home and need help. Everyone's got unique needs, and that's why this is so great, that this is so personalized and customized to the individual needs.
And it's interesting you say that, because people do open up and they go, yeah, I have 4 kids, but I got 1 kid. I just don't want direction they're going in, okay? Yeah. And I need to. I want to help them, but I don't want to help them too much. But I want to make sure. But I definitely don't want all the money to go to them if something happens to us, because they'll just blow it, So there's all these things that we put together and talk it out and get it done. And I try to have them talk to their families while they're alive, so there's not all that fighting afterwards. Oh, you talk to mom, you talk to, what I mean? It's amazing when it goes on, but not everybody's comfortable in doing that because they don't always make it equal,
Well, listen, we all have unique situations, and that is why we all need unique portfolios that reflect the individual's dreams, goals, and this is why we work so hard through our whole lives, so that we can live this beautiful retirement. And this is going to give us peace of mind to get where we want to be. That phone number is 520-544-4909. That takes you directly to Greenberg Financial Group, and that QR code on the bottom of your screen. We'll take a quick commercial break. We'll come back and talk more about your viewer questions. Stay with us.
This is Money Matters with Dean Greenberg of the Greenberg Financial Group. I'm Spike Spangle. Dean, what really got you started in this industry?
It was because I was working for Ford Motor Company. I had ordered all the dealerships, and I kind of looked at things and I said, this is not what I want. So I went back and got my MBA in finance and investments and said, I'm going to work on Wall Street. I didn't really know the journey I was going to have until later on, 1987, when the market crashed.
Yeah. Black Monday.
Black Monday. The only person in the company of 600 and some odd brokers. I was buying IBM, and I opened a $500,000 account. So they say to me, hey, this is unbelievable. How did you do this? What did you do? I just said, because I thought it was the right thing to do. Down 20%, it was probably a good time to buy, and I was more of a technician and an advisor and an educator at that time. Long story short, they tell me a week later I never owned the stock. The back offices back then could not handle 1 billion shares a day. So a week and a half later, they tell me I don't own it, and I needed to call a client to tell them they didn't own the stock. And I told them that they should pay the client. Next day I came in, my box of stuff was in there, and they told me I was fired. And I went to go see the guy I knew to go get a job. And he said, Dean, I'd hire you tomorrow, but you need to start your own business. I laughed at him and said, how am I gonna start my own business? I only have $5,000. He said, figure it out. We're all salesmen. You educate, you care about the markets, you care about your clients. So I guess I figured it out.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg, president of Greenberg Financial Group. And this is one of my favorite parts when we have time to do this. We have such smart viewers. They're really listening and they have great questions. I put together a couple of questions that I think are relevant to other viewers that I thought you might like to answer. So I'll jump right in.
Love to.
Okay, this is from Andrew. What is the difference between a Roth contribution and a Roth conversion?
At the end of the day, they both end up in a Roth account, okay? But a Roth contribution is a direct contribution from your savings into a Roth. It's just like an IRA, but it's after tax is that you put in the Roth. The beauty of that is everything that it grows from, you don't have to pay taxes on. A Roth conversion comes from your retirement account that was put in before taxes. You take the money out, you pay the taxes, now you put it in the Roth, but all the growth from there is now tax free.
And how do you know if you're eligible for, and which one is best for you?
Well, eligibility comes on the Roth I think it's about 145, 148,000. You make over that, and then it goes down. There's a sliding scale, so you have to look at what the sliding scale is. A Roth conversion, you're eligible, everyone's eligible. It's just a matter of what tax bracket it's going to send you in. If you're still working and you're making $150,000 and you want to take out $100,000, now you're going to be put at $250,000. So when you do that Roth conversion, you got to make sure it's not putting you in a higher tax bracket.
Okay.
And what you need to also do is look at it like if the markets are down, so all the assets you put in, say you have $100,000 and it went down to 75,000. And you do the Roth conversion, you're only paying taxes on 75, not 100. And then when it grows back to 100, you don't have to pay any taxes again, or 150 or 200.
Andrew, this was a very good question. I love it. Okay, you talk about the stock market doing well at times. How can you protect me if it starts to decline? And this is from Catherine.
First of all, we have to realize that the stock market over time always goes up, okay? It's the one thing I can tell you from back in 1900, all right? Every time the market's gone down, no matter how bad it's gone down, it's made a new high at some time. Sometimes it's taken some time. A lot of times recently, it's a few years, right? But it has to do it. So buy high, sell low is not the way you want to do it. You want to buy low, sell high. So when the market gets to what I consider, whatever valuations that you think, I think the market's overvalued now. But it doesn't mean it can't go higher. So what you do is you mitigate risk. You take some money off the table, okay? You bought NVIDIA at $125 last December, and now it's $450, $500, and you had 200 shares. Maybe you take 100, 50 shares, something off the table. Microsoft, Apple, all these stocks that ran up in 2023, you can raise some cash from doing it. The other thing you can do is buy the inverse funds, whether it's on the NASDAQ or the technology or the S&P 500. That protects the overall broad market. Doesn't mean you're not going to lose money. It means you're mitigating your risk, making your risk a little less. You can sell calls on some of these things, which means you're bringing in income and you're selling it at a higher price than you're waiting. Or buy puts right on those stocks that you have. Those are the ways you can mitigate risk. Protect overall broad markets, individual stocks, take some money off the table and put it into money market right now that you can get over 5% on the money market while you're waiting for opportunities. What you don't want to do is take the money that you have for growth and take it out and then put it in something that can't grow if the markets come back. You put it into something that you sit and wait. We haven't had 5% money market in a long time. So sitting there right now, You say you're up anywhere from 10% to 20% this year, and you take off 25% of it, and you put it in a money market fund. So now you have cash if it comes down. If not, you make 5% until you want to buy again. There will always be opportunities. People don't have patience. It's FOMO. You know what FOMO stands for?
Fear of missing out.
Thank you. So many people have that, and then when it goes down, they just get really scared. Fear of losing more.
Well, this is why it's so important to have a financial plan, because if you're sitting at home, you might not be pulling that trigger because you don't know when is the best time or how, or these are all, there's so many vehicles.
Right.
And this is why we need a plan. Okay, this is a question from Angela. Do you do estate planning?
We do it through the financial plan, but we're not estate planners, but we have brought somebody into our office. The office is there, that is an estate planning attorney, and he's building up his business along with ours. Obviously, we share clients. You don't have to deal with them, or you can. The beauty of it, though, because he's in my office, he's agreed to, first-time consultations are just like a financial plan. They're free. You can come talk to him. Obviously, don't talk to him for 3 hours, but come talk to him, tell him what your situation is, and then he'll tell you what it'll cost to do business with him.
I love it. Well, listen, this is the perfect time to explain to people how simple and easy it is. Pick up that phone, give you a call. You guys give them all the information and the things they need. It's not complicated. Take them through the steps of what they need to bring you, and then come in and just have a cup of coffee and a meeting. There is coffee, right?
I don't drink coffee, but everyone says we have the best coffee.
Yeah, you drink the energy drinks, don't you? Yeah. I'm good old-fashioned
Never drank coffee. Never smoked cigarettes.
I mean, you say coffee like it's a bad thing.
No, a lot of people drink it. I don't like the taste. Don't say that's a bad thing. Don't judge me. I'm not judging you.
I'm not judging. I'm trying not to judge you. I'm a little bit judging you. Okay, I'm sorry. But I'm just saying, it's an easy meeting. It shouldn't be intimidating. It's the right time to do it now to find out whether or not you're on the right plan. And if you're not, let's get you there.
We put it on a big screen TV when you come in, and it's right there in front of you, your whole financial plan, and we go through it with you.
I absolutely love it. The fact that you give this as a gift to the viewers when other financial advisors charge $2,000, $3,000, you have the option to do that and don't. This is just really a gift to the viewers of the show for taking the time to get educated and spend some time with us. That phone number again, 520-544-4909. That will take you directly to Greenberg Financial Group, not a call center. There's also a QR code on the bottom of your screen, so there's literally nothing stopping you from doing this and having that conversation with Dean. If nothing, just to get to meet him. I mean, it's all worthwhile, right?
Thank you.
Thank you so much for taking the time, and please join us on our next show. We'll talk more about the importance of financial planning in your road to retirement.